Hi, my name is Cam too. I majored in finance and business economics, and I was in charge of trading our portfolio.
Hi, my name is Charles Rashawn. I'm currently majoring in finance and economics, and my part of the project was portfolio management.
Hey, my name is Spencer Bateman. I'm a political science and finance student, and my role on the team was risk management.
My name is Hila Hoskalavici. I'm majoring in finance, management information systems, and operations management, and I was in charge of long and short selections.
My name is Edward Rashawn. I'm majoring in finance and economics, and my part of the project was factor analysis.
While constructing our portfolio, we functioned under a few constraints. They were to remain market neutral with a beta between negative 0.25 and 0.25. No more than 5% of our portfolio could be in a single stock, and no more than 5% could be in cash.
Our primary driver of returns has been our industry tilt. We decided to take an industry tilt as opposed to an individual stock selection approach, as we didn't feel as if we had an advantage in individual company analysis, but that we could develop our own unique market outlook with regard to sector performance. We believe that the November elections presented an undervalued likelihood of a government-wide Republican win, which would benefit the financial and energy sectors, while threatening the consumer discretionary sector. Because markets largely anticipated a Clinton victory, we viewed a Trump win as posing significant opportunities. We therefore took our biggest positions in the portfolio in these sectors. Looking at financials, our opinion was that Republican views on financial deregulation, coupled with likely interest rate rises, would benefit financial firms. We believed a Clinton win was already priced in, and financials would have likely not suffered given a Clinton victory. So the bet on financials, in our view, carried little downside risk relative to the potential upside if Republicans would be victorious. Our portfolio has maintained around a 40% net long position in financials. In the energy sector, Republican positions in favor of energy deregulation would decrease costs for many firms in the sector. We also believed the construction of the Keystone XL and Dakota Access Pipeline would pose significant opportunities for several companies in the sector. Throughout the competition, our portfolio has maintained around a 14% net long position in energy. Looking at our short bet in consumer discretionary, the widespread hostility towards trade agreements and Donald Trump's perceived willingness to enact protectionist policies, including tariffs on large trade partners such as Mexico, led us to believe that rising export and import costs would hurt consumer discretionary spending and harm the sector. Our portfolio has maintained around a 35% net short position in consumer discretionary.
Our secondary drivers of portfolio returns were our factor tilts towards value and momentum. We chose these two factors due to the historical evidence showing they produce abnormal returns. Value stocks have low prices relative to fundamentals, and these stocks have historically outperformed the high-priced growth stock counterparts over immediate horizons. Our second factor tilt was towards momentum. Empirically, stocks which have performed well over a previous 3 to 12 month period will outperform their peers over the next several months. Although this has been shown historically, within our own portfolio as of February 6th, momentum has had a negligible impact. We chose to implement value and momentum concurrently due to research examining the interaction of these strategies. This research shows that the momentum and value characteristics interact such that stocks that are both value and recent winner stocks substantially outperform growth stocks that are also recent poor performers. Implementing these strategies jointly produces gains relative to using the value and momentum factors in isolation. We also considered current market conditions for the value and momentum strategies. Recent research suggests that these style bets perform poorly in highly volatile periods and recessions. Given the current state of the economy and markets, these strategies may be expected to perform relatively well. As Spencer will speak to it later in more detail, we found that industry and factor tilts were collectively responsible for almost all active risk, while market risk was not a driver of return.
We sought to take on the majority of our portfolio risk through our industry bets and factor tilts. By following the constraints of a market-neutral portfolio, we minimized market risk while also diversifying firm-specific risk by diversifying across 80 individual stocks. Given our risk allocations, we expected the majority of our return to come from industry bets, followed by our style bets, and least of all, market and firm-specific risks.
To construct our portfolio, we began by screening the investment universe for stocks in the financial, energy, and consumer discretionary sectors in order to implement our desired industry bets. Within each of these industries, we identified stocks with favorable value and momentum characteristics. In particular, we found value in recent winner stocks to create long positions in the financial and energy sectors, and identify growth in recent loser stocks to short in the consumer discretionary sector. We screen stocks based on price to book value measure and relative share price momentum measure, and after ranking the relative performance of each of the stocks, we supplemented our industry stocks with additional long positions in past winner value stocks and short positions in growth loser stocks to create an equal weighted 40 long and 40 short portfolio, while keeping in mind our industry tilt and beta concerns. Throughout these past few months, we continuously monitored our portfolio to ensure that it met the challenge requirements and ensuring our risk exposures were in line with our desired bets.
Over the course of the investment period to date, we have achieved a return of 11.64%, with StockTrack indicating a Sharpe ratio of 3.18. The performance attribution of our portfolio suggests a number of positive outcomes regarding our investment philosophy. First, our portfolio has remained market neutral and within the required parameters, as no significant return impact has been contributed by market exposure. Our portfolio only included roughly 0.15% market risk. Second, our biggest drivers of return were our sector bets, where we took on the greatest risk. Our industry bets contributed roughly 10.38% return to our portfolio, demonstrating that we both correctly anticipated the value of the industry bets we made, while simultaneously avoiding indirect additional risk exposure. This return is particularly compelling, considering the risk our industry bets contained was roughly 6.5%, giving a risk-to-return ratio of 1.6. While the overall contribution to our return from our style exposures was negligibly negative, we did receive a positive contribution to our return from our value exposure. Over the course of the investment period to date, our momentum exposure did not positively impact the portfolio, but the negative contribution it had was not a significant drag on performance either. Our style exposures contributed a total of 3.6% risk, significantly less than our industry bets. Lastly, active firm-specific risk in our portfolio contributed a negligible impact to our performance as well, as the diversification of our portfolio across roughly 80 firm positions mitigated idiosyncratic risk. Firm-specific risk contributed 4.26% of risk to our portfolio. The confluence of these performance attribution factors served to show that our investment strategy was both successfully planned and effectively executed within the confines of the market-neutral portfolio parameters we were given. In conclusion, our team's investment strategy based on industry-specific bets, including a long financials and energy while short consumer discretionary position, in addition to style exposures to value and momentum, resulted in strong portfolio performance over the investment period. We appreciate the opportunity to participate in this year's CQA Challenge. Thank you for your consideration, and don't forget to
Bear down!